Welcome back, everybody. And so it's super interesting because the metrics are saying that buyers and sellers are finally adjusting to mortgage rates. They're getting used to what used to be. Anyway, let's talk a little bit about that. Let's talk a little bit about the vacation trifecta. Let's talk about what to expect over the next couple of months and what are mortgage rates going to do, or what have they done that kind of threw a kind of a little wrench in things. In the meantime, hey, let's get the show on the road here. All right, so one of the key things that we look at are mortgage rates and how buyers and sellers actually are kind of, well, how they interact with them. So as an example, as we see pending sales going up, we see transactions closing at a higher rate. And again, taking into consideration seasonality, what we look at then is how is the response? What are they doing? How are they pulling back? Are they moving forward? And we are definitely seeing a little bit of both, but mainly moving forward. When we say a little bit of both, we had some pretty interesting things happen in the market when we talk about payroll. We'll get to that when we get to the top headlines. In the meantime, let's take a look at this. According to the Northwest MLS, it says while interest rates remain high, an increase in inventory and closed sales transactions signal that buyers and sellers are adjusting. I 100% agree with that. And as if you're watching the show every single week, you will see how the pending and what's coming on market are just really neck and neck with each other every single Friday. And during the process of the week, meaning outside of Friday, because Friday is a massive let's bring our home on market day, the pendants are outperforming them. In other words, we keep bringing down that inventory a little bit, and then boom, Friday we get a massive influx in homes. And in fact, this last week we had that massive influx of homes where buyers are then having more opportunities to take a look at it. But wait, when we consider the seasonality of the vacation trifecta, today it's an absolutely stunning and beautiful day out there. And yes, a lot of folks are out doing other things. And in fact, we're seeing some of that with some of the new home construction, because they're only they're back to 11% where they should be of the actual homes available. The super interesting thing is they're seeing a little bit of pullback, but they're not seeing as many people on the plats, or at least not as many people engaging on those plats. A lot of times because their mind is elsewhere. There's existing homes that they can take a look at. We'll get to that later. Let's get to the headlines real fast here. All right. So when we pop over and we take a look at this, super, super important. When we talk about first-time home buyers and showing up to the market, why this is super critical, when we start to see a market shift, okay, many times it's because one of the demographics is becoming a more dominant player. In this circumstance, I know there's some people that argue it, but we have been dealing with a recession and crazy inflation. But here's the funny thing. When you start to see the first-time home buyers take a more dominant role, meaning they go from a 25% to maybe 38% to 42% of the market share, where they are closing on 38 to 42% of the market, that is when we start to see a market shift. Because the next step then in the process is we will start to see the next demographic, or the move-up buyers, actually start to come into play, because they kind of step with each other. And as that happens, that lets us know, because first-time home buyers tell us when we're coming into a market. They also let us know when we're exiting a market, because they fit on both ends. And right now, since we already saw them before and now we're seeing them again start to take a more dominant shift, we're going to start to see a little bit more of a market shift, especially I think as we roll into 2025, where market rate or mortgage interest rates should be closer to about the mid sixes as we start to see some adjustment, because the Feds aren't going to adjust their rate anytime soon, because they're still struggling with how to get inflation down to their 2% that they're looking for versus the 3+% that we're looking at right now, which is a big jump for a lot of things. Anyway, let's move on. Let's get back to the headlines. All right. And there we go. All right. So it's been a wild week in response to economic data. Why? Because payroll absolutely threw a monkey wrench in just about everything. And understand, when we talk about the metrics, because mortgage rates, mortgage-backed securities are publicly traded on the stock market, the feds have nothing to do with them. Yes, the feds affect them at times, but they have nothing to do with long-term mortgage rates. Those are publicly traded. Now, the good news is when bonds go up, mortgage rates come down. And when you watch the 10-year Treasury, they mirror mortgage rates. So if you see mortgage or 10-year Treasuries drop down, mortgage rates typically follow with it. If the 10-year Treasury goes up, mortgage rates historically go with it. No, they're not tied together. They're just freakishly close consistently, and therefore has become a very consistent metric for a lot of people to watch. So watch them, and that will help you to understand. When we have our Wednesdays, financial information come out, and if you're on the fence or the edge of, hey, I need to make a decision, I'm under contract with the home, and I'm looking at, or I'm doing a refinance, and I'm taking a look at, hey, what are the rates going to do? If the information that comes out and on the Wednesday financials is good, hey, you might want to just hold on and wait for pricing to come down. If it's bad, you may want to jump because you want to catch that before it goes up. Because remember, rates change like the stock market every single day. They go up and down. What happens in the morning may not be what happens in the afternoon or later in the evening. Keep that in mind. All right. As we take a look at here, let's roll on. When we talk about Freddie Mac's 7-day running average, they're a little lagging, as you see the arrow there showing that they're on a down. But the funny thing is, we actually been hitting in the high sixes, real low sevens. Again, about our 50-year average. This is where rates typically hover, right in this arena. Hence the title for this video, This is Situation Normal, okay? And that is something to keep in mind, and they will bobble in there, and depending on who's in the administration next year, it's going to have an impact on where rates are, because depending on their policies for the finances of the government and so on. So with that being said, let's move back here. When we talk about the 7-day running average, we are seeing some more improvements. We lost ground on Friday, but we had gained a little bit back. We'll see what next week brings. What's most important about this? Listen, last week we talked about this, and as you can see here at the big red circle, we have 761 reduced homes. What does that mean? It doesn't necessarily mean that our industry is pulling a back seat. No, that just means sellers were too aggressive. That's what it means. Why? Because it is clear when we take a look at the next chart here, right? Hang on a second. Let me just blow that up a little bit for you. We take a look at this. If our market was absolutely going down the old, circling with the tiny bill man, we would not have nearly 1,400 homes with, 1,500 homes coming on market and seeing during the week, other than Friday, our pending sales being up. Sales still up, okay? If we saw those numbers that were like way backed off, sure, then we would see something different with the pent-up demand of buyers that are out there. We're still seeing multiple offers. Heck, we're seeing multiple offers on clunkers. Clunker is a bad-looking house, all right? It is crazy, but understand, when you have a limited inventory, we still have a limited inventory. We're about 1.9 months of inventory, a little bit more than what we had last week, seasonally normal. Yes, things are going to start, they actually already have started to slow down a little bit because people's minds are elsewhere. That will take a big uptick typically after the July 4th weekend, in which a number of our clients are waiting to go on market until after July 4th. because then they're going to have full-on eyeballs as we see a very aggressive number of people that then come in and want to secure their home, whether for school and their kids, or they're wanting to do it, for the new year. Rates, typically we see a more of an improvement during those times, and then of course we have last minute vacations. We have Labor Day weekend. Is that right? Yeah, Labor Day weekend, then school, and everybody doing the last ditch vacation. And of course, it falls off until late September. There we go. All right. Now, let's move on. If we blow that back up again, what's super important about all of this? Hey, look, if you want accurate information, make sure that you subscribe. Here's the funny thing, right? The funny thing is, I'm beholden to nobody. I get to say what I want, when I want, and how I want. So there's no advertising. There's no selling here. It's just really solid information for you guys. Ask the questions you want to ask. We normally get back to you in about 30 minutes, except for on Sunday. And then as far as, getting you solid information, you get it consistently, and you get to make really good business decisions. Can't argue about that. So like and share with 2 people that you like, and share it with 1 person you don't like. There we go. That's kind of fun. All right, moving on. Let's get that back up. So let's take a look at the Northwest MLS, and we talk about the average price for active sales and the average price for closed sales. Now, what's super interesting about this, get a load of this. So we actually had a reduced price of, as you can see, $27,000 over last week. That's super interesting because that is quite a bit of a drop, and I wouldn't have expected that big of a drop week over week. When we take a look at it year over year, it hasn't changed at all. Now, when we take a look at it, and I'll blow this up so you guys can see it a little bit better, you can see that our average sales price last year was $762,000. This year, $843,000. We're still seeing a positive trend, although we lost ground over this last week at about $27,000. There's a lot of things that come into play on that. 1, we did have some price reductions. 2, it is seasonally normal. And 3, with interest rates that were a little on the, bobbly side, even though we saw a little bit more activity, I think that, people were either pushing on price, which is not unexpected, or they were, taking a look at a little bit better of a price. There was a number of homes that did their price reductions, went off market, and that plays into that number. Totally expected, especially if you're dealing with an overpriced home. Remember, buyers are super smart. They will not pay for an overpriced home. Just telling you. I don't care what you think as a seller, what you feel your home is worth. Doesn't matter. Because remember, a seller is a price taker. Buyers are price makers. It takes the buyer to say yes to a price. They establish what their perception of value is to a certain product. In this circumstance, it is your house. And if it is overpriced, and they'll look at it and say, no, not yet. You come down into their price point, they'll say, yeah, I'm all in. But that's what it takes. And regardless of what you think, sentimental equity has no value. Remember that. All right, my sermon is over. Moving on. So when we pop in and we take a look at what's going on with just pricing, get a load of this. All right, let's zoom this in. Okay. Year over year, basically we have a zero gain loss as far as homes sold. First time in a long time, that telling us that, hey, we're getting it right. Pending sales are up 2.1%. But here's the funny thing. Month over month, surprisingly, when we take a look at it, I should say year over year of the same month, we're actually down almost 17% on inventory, which is only about 336 homes. But that is an interesting trend because we're still seeing a lot of sellers with the golden handcuffs and, with their rates, and they're not willing to make that move, which again, because our inventory is quite a bit low, well, it's half of what it normally is, which is a good thing because really I think we're more at a balanced market, just hedging slightly on the seller side, not much, just a hint. Okay, so if this is neutral, buyers, sellers, we're just right there. We're not way over, we're just barely over. Anyway, just gotta love the sound effects, right? Make them myself. All right, when we pop in here, and then we take a look at new construction, right? So yes, we're still seeing a lot of the advertisements, quick move in, standing product, they want to get off. There's a lot of opportunities there. But when we take a look at the pricing here, super, super interesting. So we're $35,000 less in average sales price this week than we were last week. And last week, we were $10,000 below. So over the last 2 weeks, the average sales price actually is $45,000 less. Now, we're only $6,000 lower from last week, but still above year over year as far as actual net gains. And that is a super important metric because as we start taking a look at what is on market, what is pended, what is the velocity, right? And we take a look at this a little bit deeper, we can see that our sales are off about 91 homes year to date, 115 pended off. And that is, well, it's a little concerning because I wouldn't have expected with some of the newer homes that are out there for that. But if you're saying, well, geez, George, what's going on? I think there's a couple of things that come into play here. And this is my humble opinion, all right? One, builders have truly been pushing price pretty hard. Why? Because there weren't enough homes out there. But now that we've seen a nice influx of what we will call resales, okay, that is pulling some of those buyers away from the plats because, well, they're better priced. Sure, people go in, they'll do their updates or not, and buyers are looking at it and say, hey, we can do a number of things with this house, and there's a few dollars we can make this a little bit better, but I don't have to pay that premium for new construction. Okay. Pricing with the plats, they've been pushing price, even though they're offering incentives, they're definitely hammering that price in an upward trend. And buyers are giving a little bit of a pullback, and that's why you're seeing some more creative ideas with the builders because they don't want to play with the plat pricing, and now they're having to adjust, hoping that some of that resale inventory comes off, which will then help them because they've gone from 30% of our market share back to 11%. So they're not as popular as before. Moving on. Okay. When we take a look at, hang on a second, let's pull this thing up here. Let's get back. We take a look at bank owned. There's something super interesting about bank owned. I just don't get this one. All right. There's a special word that I like for this, and it's called Bumfuzzle. I am bumfuzzled by these people. Why? Because there are still 9 people out there that, and I just stopped when I got to 9, because I look at 4 different counties when I get done with the 4 different counties. If I was their listing agent, I would be seriously concerned. If I was a seller, I would be super, super disappointed. Here's the thing. We're 18% down on inventory. Foreclosures are not on their way up. In fact, there was an article that was put out saying, hey, the shadow inventory of REOs or foreclosures or defaulting borrowers is disappearing. No kidding. Why? There's so many options, so many options out there for borrowers that, well, are lagging behind for any number of reasons. So loan modifications are super popular. Short sales, still almost non-existent, right? Foreclosures, minimal, especially in our area. Really, it's peanuts. Just telling you, it's peanuts. If you're banking on a foreclosure, if you're banking on the market tanking, if you're banking on interest rates getting back down to 3%, you should probably reconsider what you think, because you're wrong, and watch my show more often and maybe have a better, deeper chat, because we can clearly show you we do not have enough inventory for our market to crash. We're still one of the top 5 sweet spots across the United States. Interest rates have leveled out. Buyers and sellers have acclimated to this. They are clearly showing this. And until we see a massive influx in homes, and I mean like massive, we're at like 9,000, 10,000 homes during the process of any one week. We should be at 18 to 22,000 homes. Take that for what it's worth. I would love to chat with anybody because, well, I know my numbers. Yes, this is never a pre-recorded, what do they call that? There's no script. I just tell you what I know. And because we do this every week, I can have really great conversations with you. Why? Because if we come over here and I do this and do that, remember to smash that subscribe button. Let us know that you like it. Share it with 2 people that you like and 1 person that you don't like. Make sure that you're doing that because then YouTube tells everybody, hey, this is some good information. Come and learn something. That's all this is. In the meantime, have an absolutely fabulous weekend. I'll see you on the next video. And in the meantime, have a beautiful day. Take care.